We're here with Peter Coburn, the Investment Director of the SWIP UK Opportunities Fund and Interim Head of UK Equities at SWIP. Peter, first of all, how did the fund perform over 2009 and how has it been performing over the first quarter of 2010?
Yeah, we had an excellent 2009. Fund was top decile over the year. We're top quartile now for 1, 3 and 5 years, so very consistent, strong performance over short and medium term. This year started fairly flat. We had a good January. We gave a little bit back in February. The way we're moving the fund at the moment is slightly more defensive to some of the more reliable growth style stories in the marketplace, and that's really been driven by our bottom-up investment process, which is pointing us to value in the more stable, reliable growth stocks.
You are producing a consistently strong performance here. Can you tell us how your investment process has helped steer the fund to that?
The investment process is very bottom-up in style. We look at every stock as an individual stock. We also do a lot of industry analysis, really recognising that stocks don't operate just in isolation. Often the industry dynamics are as important or even more important than an individual company's dynamics. So we're very style rotational. We will move where we see value, so that might be in the more stable growth style companies like tobacco, pharmaceutical stocks, or it might be in the more cyclical stocks such as financials and resources. So we never get wedded to one particular area of the market, and we'll move where we see value.
How have you been positioning the fund to counter the global economic downturn?
The fund was very defensively positioned through 2008. So as we saw the meltdown unfold in the financial system, we actually held some gilts in the fund, which we were allowed to do in terms of using 20% out with UK equities. We held a bit of cash, and we held very stable, reliable, mature companies in sectors such as pharmaceuticals and utilities, where they're less exposed to the economic cycle. But through 2009, valuations became so bombed out, if you like, pricing in almost the sort of Armageddon-style economic scenario. We started to find value in some of the companies which had been hit very hard in the downturn, but with keeping a focus on balance sheet strength, so companies that didn't necessarily need to raise money. And as we saw the year unfold, corporate profits started to recover gently, but really economic leading indicators were pointing to a recovery in corporate profits through certainly the second half of last year and into 2010. So we started to buy some more cyclicality into the portfolio, but that's run very aggressively. So again, we're finding more value back in the sort of the more defensive parts of the market.
Many of the fund's star performers like KSK Power, Great Eastern Energy and Indus Gas are UK-listed companies that derive much of their revenue from India. Are all the best opportunities in the current market coming from companies whose earnings are perhaps similarly derived outside the UK?
We're certainly finding a lot of opportunities around companies that have the vast majority of their revenue streams outside the UK, and that's really because economies such as India that you mentioned are growing so rapidly. So even through the downturn, growing at 6-7%, and again that growth is re-accelerating, and that simply comes from the fact that in power, for one example of where we're invested in emerging market power, there is a huge dislocation between supply and demand. So in India, going back to India as an example, we think the power market there, if you look at government statistics, will be 30-40 years away from being in equilibrium in terms of supply catching up with demand. So yes, there's definitely opportunities in emerging market economies.
Now, it looks like the Bank of England's quantitative easing programme might be coming to an end. What effect do you see this having on the performance of the economy, and how will it influence the way you manage your fund?
We think any withdrawal of the quantitative easing programme will be very gradual and actually quite difficult in some ways to put exact numbers around how quickly they're withdrawing liquidity. But certainly it will be bad for the bond market. The government's been a very big buyer of the gilt market. So supply will continue, but will the demand be there to meet that without the government stepping in?
In recent weeks, the UK government borrowed another £4.3 billion to plug the growing hole in its finances. Given the concern over Greece's sovereign debts, should we be worried about what's happening over here?
I think we should definitely be worried. If we look at the last decade, then we've effectively added 1% on an annualised basis to our gross domestic product through borrowing So effectively, we've done what any company can do, and that is borrow more to generate sales. So we're in a very difficult fiscal position. The concern for us in a medium to long-term view is that that'll take a long time to work through, and therefore will undoubtedly be a break in economic growth. That said, the UK stock market, we forecast this year 70% of FTSE 100 sales will come from overseas. So while it will definitely be a headwind for the companies operating with businesses in the UK, clearly it's not such a big issue for companies out with.
Looking to the future, do you think interest rates will rise significantly this year? And what impact do you see that having on the UK market and indeed on your fund?
We expect rates to start rising through the second half of the year. We think the withdrawal of liquidity in terms of monetary policy being tightened will be very gradual, because the economic recovery is very gradual. But it clearly will not have a helpful impact for risk assets such as equities if there's less money supply availability. So we're positioned with an underweight. We currently have an underweight position in the UK, and what I mean by that is if you look at companies generating sales in the UK, we have less than the market as a whole. In our portfolios, we have a preference for companies with foreign sales, because we do think the fiscal and monetary environment within the UK is going to be difficult looking into the next 2 to 3 years.
What are the advantages for continental European investors looking to participate in UK equities at the moment?
At present, the UK market has been very out of favour with investors, particularly companies which have a UK facing business. So the pressures on the consumer in the UK have been very well documented. The fiscal problems in the UK have been very well documented, which means valuations in areas like general retail, real estate are very depressed. So for European investors, having to factor in the exchange rate, the future direction of the exchange rate is clearly going to be important. But at the moment, there's some very interesting relative value in the UK against what similar companies in the Eurozone are valued at.
Outline for me your outlook for the UK compared to the broader European market over the next year and beyond.
I think we see the case for equities as a global case nowadays, that we have so many sales being generated outside of the UK from constituents of the UK market, that actually the picture for us on a global basis is more important. So economies like China, like the US, other big emerging markets, we see as crucial to the outlook for the UK. And with that regard, we still see economic leading indicators in the major economies pointing to further recovery. However, our concern is that valuations in some parts of the equity market are already pricing in a strong recovery, and hence we think the best of the gains for equity investors, certainly in the short term, have already been made.
How do you see equity markets performing relative to other asset classes this year?
The biggest positive for equity markets, I think, from this point is that they still offer good value relative to other asset classes. So the bond markets still look expensive to us. Property has had a very strong run. Credit, investment grade credit, corporate bonds have performed very well. So relative to other asset classes, equities still look attractive. But I think, as I say, the best of the gains within equities have been seen.
Looking further into the future then, can you give an outlook for the UK equity market over the next 5 years?
Always difficult to look that far out, but we continue to look for companies with strong franchises, and by that we mean companies with good market positions, well managed, respected management teams, and strongly financed, so the ability to turn on CapEx tap or turn it off, and indeed look for acquisitions if there are opportunities. So we continue to search for the best companies across the market, whether that is in reliable growth in terms of where we're finding value at the moment, or whether it is in mining companies where we've played very successfully in the past few years, but we think are looking a little bit expensive at the moment.
Peter Cockburn, thank you very much.
Thank you.